This is Unit 9 of 9, final unit of my Introduction to Business class. And this particular unit is all about finance and the basics of accounting. How do businesses keep track of money? My hope is by the end of this unit that students will be able to answer the following question: how can a business make money yet still struggle financially? The objective is that students will be able to explain revenue, expenses, profit, cash flow, and the importance of accurate financial records. In every one of my units, I do provide you with a teacher guide. If you're one of my teacher friends out there using this resource from Teachers Pay Teachers, if you're one of my students, you can skip on through this slide. All of this is just a suggested workflow pacing for you to get an idea as to how much time you can expect this to take. In every one of my units, I provide students with guided notes so that they can follow along while I'm instructing whatever the content might be. And in this particular case, it's pretty cool because students get a chance to work on a mock income statement as well as a few other different types of financial accounting statements for a business of their choosing. Specifically, I have them work on the business that they pursue for the entire semester in my class. If you follow my full semester curriculum, have them do that as well. If you're not following my full semester curriculum and you purchase this as a one-off, then have your students come up with a business of their choosing, and ideally something that's not currently created. It could be just a coffee shop, it could be a bike store, it could be a fill in the blank, whatever it may be, uh, but not something like Starbucks or not something like Walmart. Make it something that is smaller scale and something that is the industry, but not necessarily the existing business. Anyway, here we go. Let's move. Why does finance matter for every single business? A business can sell a ton of things, but still fail if they don't manage their money properly. Finance helps businesses see if they're actually making a profit. It shows where money is being spent and where it's being wasted. It helps owners plan so they don't run out of cash. Now that we see why finance matters, let's look at the tools that businesses use to track their money. So we need to know the general idea of revenue versus expenses. And the key idea to stress is that revenue is not the same thing as profit. Revenue is actually the money that a business earns from selling its product or service. Expenses, on the other hand, are all the costs it takes to run the business. A business can bring in a lot of money, but if expenses are high, it might not actually be making a profit. Here's an example that I would have students walk through. So if a lawn care business charges $40 to mow a yard, that $40 is revenue. That's the sale. But the business still has to pay for things like gas, equipment, repairs, supplies, helpers, and those are all different expenses. So now that we understand revenue and expenses, we can start to talk about what's left over, and that's the idea of profit. So what is profit? Profit is what's left over after expenses are paid, not the total money collected. Revenue is the money a business brings in. Profit is what's left after paying all expenses. Profit is how owners know whether the business is actually going to be successful and sustainable. So I have my students walk through that same example. If the lawn business makes 40 bucks, but if they spend $22, the leftover profit is $18. Businesses use this profit to grow, to pay themselves, or save for emergencies. If expenses go up, what happens to that profit? This is to get the students to start to think, well, shoot, maybe I can't just cut everybody a deal and compete on the lowest price. And in fact, for my entire semester, one of the things that I stress is that students cannot pick a business that is simply thriving based on being the low cost leader, because I tell them if you go with that strategy, you will get priced out by an Amazon or a Walmart or some other big box store that can crush you on economies of scale. So profit on paper versus cash in real life. A business can look profitable, but still struggle because it doesn't actually have the cash yet. That landscaping business might have earned $1,000 on paper as revenue, but the customers may not actually pay that business until the next month. Or what if they fall behind and they don't pay you for 2 months? The business still has bills to pay. And this is where real businesses get into trouble. I emphasize the difference of profit on paper not always meaning cash in the bank. So to connect this to real life, think about when someone promises to pay you later. You can't spend that money yet. Businesses need cash to buy gas, pay workers, and keep running. So, as a quick check for understanding, I have students think about this. If the business can't collect money for 2 months or more, what problems might happen? I try to guide them towards the idea of late bills, debt, borrowing, falling behind, shutting down, even as a drastic scenario. And so, what is cash flow? We define cash flow as the movement of money into and out of a business. The goal with this slide is to help students understand that cash flow is about timing, not just profit. Cash flow means how money moves in and out of a business. Cash in is when customers actually pay. Cash out is when the business pays bills, pays workers, supplies, rent, etc. I connect this back to that landscaping example. Even though they earned $1,000, the money hasn't arrived yet, so they can't pay their bills. That's negative cash flow. I bridge this to the next idea that why cash flow is about survival. It tells us if the business can pay its bills right now. And so we do a cash flow check activity. So students take on this example where Maya runs a small snack shack stand after school. During 1 month, she earns money from selling snacks, but she also has to pay for supplies and other costs. Here's what happens. So I list out all the cash coming in and I do the cash going out. And some students are going to rush ahead and they'll just add up all the cash coming in, add up all the cash going out. They'll do the quick math and they'll say, all right, well, here's how it ends up being. But there's more to it because if you notice in the cash coming in, there's customers that haven't paid yet, and it's a pretty hefty chunk. So I walk through the setup. I give them the full scenario. If the money hasn't actually been paid, it does not help cash flow yet. I ask students which numbers are actually cash in the bank. Students should leave out that $170. I then let students calculate the total cash in, the total cash out. They find that there is Maya earning 750 bucks but only collected 580, so she actually runs out of cash because she spent $590, leaving her with a negative cash flow of negative $10. Then we get to thinking about not just this as like one of those complicated word problems, but think of it as a real entrepreneur. What could Maya do to improve her cash flow? And so the transition to that next slide is to have them compare their answer with the steps and see if Maya's cash flow is healthy or not. So I give them this information. I give them a few minutes to work through it. I'll click back and forth between the screens to show my goal here is to show that revenue can look good, but cash flow can still be negative. And the hope is that while students are doing this math, they find out really quickly that the negative cash flow uh, needs to be a discussion within the business owner as to what needs to change so this doesn't happen. Do they collect money sooner? Do they stop doing IOUs? Do they cut spending, smaller inventory? Do they have to cut a certain item off of their menu? And a key reminder is cash flow is whether or not she can pay the bills right now. And so, with this information, now that we understand cash flow, we can now start to compare it to an income statement because there's tons of similarities. Cash flow is survival today. That's the money that you actually have now, versus an income statement is talking about performance over time. And so, to move into income statements, I use this transition to help students understand why both tools exist and how they answer different questions. Cash flow tracks actual cash moving in and out. It tells us, can we pay our bills right now? Whereas income statements track revenue, expenses, and profit over a period of time. It tells us, did we make money overall this month, this year, this quarter, or whatever that period of time is. So I really emphasize cash flow is survival today. Income statement is performance over time. And that income statement is very complicated if you look at a long, full business's income statement, and there's a lot of moving parts to it. But when we break it down to its simplest form, we really can figure out that it's not that overwhelming. So I explain that the income statement measures profit over time, not cash in and out. So I say something like this: an income statement shows revenue, expenses, and profit for a chosen time period, usually a month, a quarter, or a year. An income statement helps answer the question, did the business make money overall? I then walk them through the example quickly of there's a business with a revenue of $1,000, they have expenses of 750, the profit is 250. So even though the business spent money, it still earned more than it spent. That's a $250 profit. The key difference from cash flow is that the income statement counts money when it's earned, not when the cash actually shows up. That's why profit and cash flow can be different. Which moves us into the next business accounting statement. And all of this is super high level. This is something that is done in a week. This is not a full accounting class. This is a crash course to give them the basics. And this gets us into the very basic discussions of what will be coming in the form of what's called a balance sheet. And so, in order to even understand what a balance sheet is, we need to discuss these definitions of what is an asset, a liability, and what is equity. So, I show students this how businesses measure what they own versus what they owe. Assets are what the business owns. These are things that have value, things that can be converted to cash, tools, inventory, or equipment. Liabilities are what the business owes, so things like loans, unpaid bills, credit card balances, and equity is what's left over for the owner after all of those debts are paid. So I connect this to real life by saying this: if a business owns a lot but also owes a lot, it may not actually be worth that much. So the key takeaway here is to emphasize that equity grows when a business adds valuable assets or pays down their debt. A strong business has these valuable assets and manageable debts where equity can grow so that the business can increase their assets or reduce that debt. And everybody wants this because investors are going to see their investment go up, the business owner is going to see their profits go up, and then the consumer will hopefully see innovation and possibly changes in pricing and structure and products and services that are offered as a result. So, what is a balance sheet? A balance sheet shows what a business owns, what it owes, and what's left for the owner at a specific moment in time. This shows students how these assets, liabilities, and equity all fit together on one statement. A balance sheet shows what a business owns, owes, and left over for the owner in a specific period of time. I like to think of this as a financial snapshot. It shows exactly where that business stands right now, this second. So if I have assets of $12,000, liabilities of $8,000, it's a quick equation to say that assets minus liabilities is $4,000 of equity. I then highlight that $4,000 is the owner's value in the business. If they were to liquidate it right now, they could pay off those debts, and that's what would be left over. I also note that there are varieties of the formula so that you can just plug and play depending on what variables it is that you know, and you can see those formulas at the bottom there. So the quick check question for comprehension is: if liabilities go up but assets stay the same, what happens to equity? The expected answer is that equity is going to go down. And so, continuing this check for understanding, we give them a scenario. So, I have my students practice adding assets and liabilities and finding equity. I walk the students through the math, or at least I let them work first, and then I reveal the steps. So, step one: what are the total assets for Jordan, who runs a small lawn care business? Here's what the business owns and owes today. So, we see that they have some assets, we see that they have some liabilities. First step is to figure out our total assets. Well, we have cash, tools, and customers that still owe us money. And so our total assets at this time are going to be the sum of that at $5,600. The second step is to add up all of the liabilities. That's our loan, unpaid bills, and that gives us $3,200 in total liabilities. Step three is to find the equity. And so we find the equity by using one of these formulas of equity is equal to assets minus liability. And if we know that our assets and liability are the sums mentioned before, then we can find our equity pretty quick. I let the table groups discuss it. I then, at the finishing piece of this, ask if Jordan's business is in good shape or risky shape and why. My expected reasoning is that Jordan is going to be in good shape because the assets are greater than the liabilities and equity is positive. The big takeaways specific to this unit: my goal is to reinforce the big concepts before moving on or doing practice. I talk through each bullet briefly. I show them that tracking matters. Businesses must track revenue, expenses, and profit to know if they're actually making money. Sales is not cash. A business can sell a lot, but if a customer hasn't paid yet, it can still run out of cash. Cash flow means cash right now. Cash flow shows whether a business can pay its bills today. An income statement shows over time. So it shows whether the business made money during a specific period, whether it's a month, a quarter, or a year. A balance sheet is a snapshot that shows what the business owns and what it owes and what's left in equity at a single moment in time. Good records prevent failure. Organized record keeping helps businesses avoid mistakes, missed bills, and bad decisions. Optional check for understanding questions are as follows. Here's what I would ask: which report tells us if we can pay bills right now? The answer should be cash flow. Which report tells us if we've made money over time? The answer should be an income statement. What does equity represent? The answer should be the owner's value in the business. I then have them apply it to a business idea. And again, in my class, students are pursuing a business for the entire semester in a business plan that they are creating. And that business plan that they're working on should be able to answer these following questions. So I help students start thinking like business owners and connect today's concepts to a business. If they're fully using my full semester bundle, if you're one of the teachers out there doing that, apply it to the business for the business plan that we worked on all semester. If you're not, just have students pick any business of their choosing. Keep it, within a smaller industry. Don't make it something gigantic, something that's small scale, like a smoothie shop, a lawn care business, a coffee shop, a shoe store, something like that. These are the kinds of things that real entrepreneurs think about. The biggest expenses that every business has: big costs, supplies, rent, advertising, workers. Start thinking about what yours might be. For cash flow, think about, even though that good businesses struggle with money coming in late or unexpected bills pop up, imagine what might cause cash flow issues for their business idea. Is it something where it's like, I have to order this from, XYZ country, and there's this shipping delay, but they require me to be able to pay the money up front, but I don't receive the items for a couple months? That could be a cash flow problem. Or maybe it goes the other way around, where you deliver a product or a service and then you don't get paid for 60 days after the date of service or that product delivery. I then have them think about which statement would be the most useful for their business as they